After getting major central bank announcements and the October NFP release out of the way last week, this week is relatively light on economic data and events. However, there is still some important data, and the main focus will be on inflation data coming midweek, with CPI data being released on Wednesday. The expectation is that CPI rose 0.5% in October, which is higher than the 0.4% we saw in September. This means that the annual rate would be at 5.8% in October, which is up from the 5.4% annual rate that we saw in September and would also be the highest level since 1990. However, if you take out the more volatile prices of energy and food, core CPI is likely to have seen a 4.3% annual increase, which is obviously not as high, but still on the rise compared to September's 4% level, but that's lower than the 4.5% annual level we saw in July, which was the highest increase in core CPI since 1991. Now, obviously, people are keeping an eye on whether inflation's getting out of hand and showing signs of being persistent, but since we just had the comments from the Federal Reserve last week, it may ease some of that uncertainty. Obviously, Jerome Powell assured that the Fed wouldn't be allowing high inflation to become a permanent feature of American life. However, he did point out that inflation would be high well into next year, and also he gave the Fed's definition of what transitory actually means, which was all about whether the inflation level would leave permanently high inflation rather than it necessarily being about the length of time that inflation lasts for. And also the Fed, he points out, it looks at medium-term inflation and is held accountable for that. And what's happening now seems to be more on the short-term side of things. At the moment, it's clear that a lot of issues with inflation are due to supply chain issues, and monetary policy isn't really best placed to deal with supply issues. So raising rates isn't going to solve the issue of cost-push inflation. On the other hand, the Federal Reserve is targeting maximum employment, and we had some very strong numbers coming out on Friday for October, as well as upward revisions of previous months as well. Now, the issues with supply chains and the large number of job vacancies at the moment has pushed up wages and salaries rapidly. But for now, Jerome Powell has said that they don't see there being any kind of issue with wages or any kind of wage price spiral. So all of that we've just discussed makes it kind of tricky to know exactly how the markets are likely to react. But fortunately, it's relatively easier when you're towards highs in a few markets and interacting with key paths of resistance. So for example, if we look at US stocks, they've pushed up to all-time highs, and looking at the Dow in particular, it's around a path of resistance based on the daily chart, with the intraday timeframes not looking as convincing for more of a push up at this point. And with the US dollar, if we check out the dollar index, at least the 4-hour chart, we can see that at the time of filming this video, it's really struggling to break through that level around 94.5. So let me know in the comments which markets you're following this week and how you see US stocks moving in particular. And while you're doing that, if you could hit the like button to support this channel, I would really appreciate it. So over the weekend, I came across a really interesting article from Lance Roberts, and he was suggesting that there's a chance that we could be in for a crash in US stocks. Now, personally, I think that's a bit on the extreme side, but I do think there are definitely good arguments for a bit of a bearish move from here, especially given the technical factors that I just mentioned. So let me just briefly summarize a few of the points that he outlined in his article, but I think it's definitely worth looking at further, definitely worth reading the actual article yourself. Now, firstly, he points out that the S&P 500 has only been down 2 days out of the last 18, and that's not happened at all in the last 20 years. So he suggests this is perhaps a sign of irrational exuberance, and speaking of that, he also mentions Robert Shiller's CAPE ratio being near the dot-com all-time high. But to be honest, I don't give much credibility to that specific measure, since Victor Niederhoffer's team tore apart Shiller's work, and that's something we can maybe discuss another time. The Fear Greed Index is in extreme greed territory, and demand for put options fell to new lows, showing that the market has a real lack of fear at the moment. Consumer confidence is completely decoupled from the rise in the stock market, which already is maybe a red flag, but could also mean that any declines in the market could harm consumer confidence even more. This would obviously affect company earnings. And on top of that, producer prices are at the highest spread to consumer prices in history, meaning producers can't really pass on more costs to consumers. so they'll have weaker profit margins and therefore lower earnings in future. And that's just a few of the data points that he goes through. As I said, I don't agree with all of it, but some of it's definitely very eye-opening. It at least suggests that upside from this point in time might be limited, and to be honest, I don't see any reason why we can't be looking for intraday or intra-week setups for short trades in the major stock indices. For weeks in our live stream trading sessions with our members, I've been showing how much the Dow has been respecting our significant levels, and on a number of occasions we were able to call the tops and bottoms of the markets for that particular day with absolute perfect precision. And I think the same is going to apply now as well. So if you want to know more about that, how I trade, you can find the link to follow my trading in the description box. But that's all for today. See you tomorrow. Take care, guys.